Bob, when we think about, these, let's say these countervailing forces of inflation, what are some of the forces that are still driving inflation higher on the positive side of the scale? Are we seeing, you know, um, an absorption of goods and services pricing on the growth of the money supply that was added since COVID?
Yeah, I mean, I think in a large, diversified, service-oriented economy like the U.S., a big part of what drives inflation is services prices, and those services prices, it's the services cost relative to the productive growth of creating those services, and so I think when you look at the U.S. case in particular, we had a lot of the initial inflation was goods-oriented inflation. Supply shocks created a squeeze in goods, used cars, new cars, uh, furniture, just all sorts of stuff like that,
Mhm.
which went up a lot. And also because we were in COVID, our consumption pattern shifted a lot to those goods because we weren't engaged in, service-oriented activities nearly as much. And so that created a squeeze on those prices. But as the supply chains have been mostly resolved there, meaningfully resolved, we started to see those prices certainly rise less. And actually, many of those prices have been actively falling over the course of the last couple of years. That has been a negative. I mean, a negative meaning a beneficial drag on inflationary pressures. But what's happened is wage growth has continued to, has picked up during that period. And wage growth basically defines services inflation. Like if you're engaged in a very straightforward services, let's just say lawn mowing again, you know, what is the underlying cost structure of lawn mowing? I mean, it's basically like gas, although that's a relatively small amount in the scheme of things, and the labor costs. So if wages are going up 5% a year, then you basically have to pay, you have to ask for more 5% a year increase in prices. That's just how it goes in order to maintain your margins. And so I think that's basically what we're seeing in terms of what's creating the structural, a big, important structural support to inflation being elevated is just that sort of in many ways very boring, like, wage inflation is price inflation. That's just how it goes.
It becomes price inflation.
It just becomes price inflation.
Yeah.
Right. Because otherwise businesses margins would be hit. And there's been a little bit of a story, particularly with big businesses where their margins haven't really been hit. But if you're and they've raised their prices in excess of their labor costs for like S&P 500 companies. But like if you're literally a lawnmower, a lawnmower company, like it's pretty straightforward in terms of what your costs are relative to what the prices that you're charging people.
Mm-hmm. And then what? Again, I think there's a lot of good, let's say, symmetry or ways to explain and paint this picture of a lot of these things that we're talking about today by really using a scale. So on the other side of that scale, what are some of the big deflationary forces that have helped temper these hotter PCE numbers, for example, that we've been seeing over the last couple months?
Well, I mean, goods and capital goods in particular have benefited from a fair amount of disinflation or deflation over the course of the last 12 to 18 months. And so you think about something like used cars, used car prices,
well, right?
Yeah, used car prices, rents have moderated. The price level hasn't really changed, but the pace of price growth has slowed. In part, something like used cars or furniture or other things has been a function of supply chains starting to get resolved. Something like housing and particularly rents, has benefited over the course of the last 18, 24 months from a significant increase in supply, particularly in those hot Sunbelt cities where you're seeing, a lot of multifamily apartment supply, basically at secular highs, which has brought a lot of supply into the market, which has helped depress rents, bring rents down or bring the growth of rents down considerably. And so, those in a lot of ways, that's like any price is just a function of supply and demand. And in a lot of ways, what we saw on the goods side, as well as to some extent in the housing side, is an increase in supply that has helped create, has helped bring down price pressures.
So
And the problem, actually, I would just say, and the problem is with goods and houses, you can produce a lot more of them. The problem is with services, it's actually pretty tough to produce a lot more of them, at least on an 18-year lag, right? In terms of people getting into the workforce. And
or even just training new skilled labor too, right?
Exactly, right? And so I think that's where the supply problem, if you're going to think about it from a US economic perspective, is that we have a labor supply problem. So we still, in some ways, the inflation problem is still a supply problem. It's just a labor supply problem, not really a goods supply problem. And so, and that's been exacerbated post-COVID for a number of reasons. I mean, one, there was actually, a fair amount of, let's say, post-COVID illness-related reduction in productive capacity by millions of people, basically, in one form or another. And then on top of it, there's been an increase in excess retirements that has far outpaced what expectations were, a few million of those. And so, you've pulled like 6 million people out of the labor market over the course of a couple of years. That's a pretty big impact in terms of thinking about labor supply. It's pretty hard to find 6 million people to come into the labor market, particularly the skilled labor market, with any, at that pace or that rapid an increase in labor supply.